Over the course of the next 10 to 15 minutes or however long this video is, I'm probably going to teach you guys one of the most valuable lessons that you can learn when investing in individual companies. What is going on, guys? Hope you guys had a great weekend. I was sitting there the other day and I'm thinking, what do I want to make for my video on Monday? And I really wanted to make it a video that was just going to be jam-packed with a ton of value, but I didn't want to make it overly long. I didn't want to make it like a 30-minute video or anything like that. And I ultimately came up with the idea of teaching you guys how to calculate intrinsic value. This is something that's not going to be super complex. It's something that you're going to be able to implement rather quickly, and I think even the newer investors are going to be able to grasp this pretty well. Hope you guys enjoy this video today. If you do get some value out of it, and if you have been getting some value out of these videos that we've been putting out, make sure to drop a like on the video. That really helps out the channel in a massive way, and it only takes a second of your time, and I really appreciate every single one of you that like every video. Also, don't forget to subscribe to the channel as well. That also helps the channel grow. We're really starting to grow here, and yeah, I'm really excited. So let's get to it, guys. So before we get into calculating intrinsic value, you guys might be wondering what exactly is intrinsic value and why do I even care what it is? Well, basically intrinsic value is just calculating how much an asset is worth. In this case, it's going to be stocks, or in other words, how much the individual company is worth. And we're going to use that to find out how much we want to pay for these individual companies. Keep in mind, guys, what I am about to teach you, I in no way came up with by myself. I've seen a lot of ways to calculate intrinsic value. There's a ton of ways to calculate intrinsic value, but this way I'm going to teach you is very simple. I use this myself. I feel like you guys are going to understand this pretty well. So don't give me 100% credit for this. You've seen, probably can look up on YouTube and you can find dozens of people that have actually used this and made a similar video to this. But for my audience, I want to make this video because I think it's very important. This method's also more so for value investing. So say you want to buy something like Apple stock. You might want to find out, am I buying Apple stock at a good price what it's trading at today? Or should I wait until it comes down? Should I see if I can get at a better price? Or is it way overvalued if I buy in today? This might not apply to growth investing because growth investing might apply a little bit more of a vision than just running numbers. So in order to calculate the intrinsic value, we're going to need 5 different things. Well, 6, if you might want to calculate it, just a recommendation, but we're going to need 5 different metrics we're going to need in order to calculate this. We're going to need the trailing 12 months earnings per share. We're going to need the growth rate, how much this company that we're looking into is supposed to grow. We're going to need the minimum return on investment we want to see annually. We're going to need the margin of safety that we're willing to tolerate and that we would like. And then we're going to need the PE ratio of the company we're looking into. So there is a couple of different ways that you can do this, okay? So obviously for like the earnings per share and like the PE ratio, you can just get those things from like Yahoo Finance or maybe MSN Money, which we are going to do in this video. As for the growth rate, you can either come up with that yourself based on where you think the company's going to grow, which I would recommend because obviously you're investing based off your own opinions. But for the sake of this video, we're just going to get the growth rate from Yahoo Finance. But for like margin of safety and minimum return on investment, guys, you obviously got to come up with that yourself because you can't just like Google like what should I put in for the margin of safety. Like that's just not something that you can do. You can go off of someone else's opinion. You got to come up with that yourself. So the company we're going to be looking into to calculate the intrinsic value to decide if we should buy it or not is Apple, okay? So if we go to Yahoo Finance and we look up the trailing 12 months earnings per share, we're going to see that Apple currently has a trailing 12 months earnings per share at $3.28. Now again, we're going to do the same thing for the growth rate. We're just going to use Yahoo Finance here for the sake of this video. Again, like I said before, you should probably calculate this based on where you think the company's going to grow over the next couple years. Because sometimes Wall Street is not all it's cracked up to be, all right? If you know what I mean. Sometimes Wall Street sleeps on some stocks, sleeps on some growth. You might want to calculate this up. That's just my recommendation, but as always, do what you want. So if we go on Yahoo Finance and we see what Apple's projected to grow over the next 5 years, they're projected to grow 12.64%. Now the minimum return on investment, that's something you're going to have to come up with on your own for a lot of different reasons. For the sake of this video, we're going to use a minimum return of 15%. So why are we using 15%? So obviously if we wanted like an 8 or a 9% return, we would just stick our money in an index fund because it's much safer, right? But we're picking individual stocks in this video. We're taking more risk, so we want more back, right? So we're going to use 15% for this. Now the margin of safety, that's another one that you guys are going to have to come with on your own. For the sake of this video, we're going to use a 50% margin of safety. So what does that mean? So when the company's valued, let's say the company's valued at $100, right? The company is worth $100. We don't want to buy that company unless it's trading at $50, and that's going to give us a 50% margin of safety. If we wanted a 75% margin of safety, we would not buy it unless that company is at $25. If we wanted a 25% margin of safety, we would buy that company at $75, okay guys? 50% margin is actually a pretty big margin of safety, but I think for people that are just starting out, it's probably a pretty safe margin because you might just want to dabble in a little bit and get involved in some individual stocks and not just take a ton of risk, if you know what I'm saying. So the last metric we're going to need here is the PE ratio. And we're actually going to do this by going to MSN Money. And MSN Money actually has the 5-year high PE ratio for Apple and the 5-year low PE ratio for Apple. So if you guys are looking at what we have on the screen right now, the 5-year high PE ratio for Apple is 34.28. And the 5-year low PE ratio for Apple is 13.57. So what we're going to do is we're going to take the average of those two PE ratios, and what that comes out to is 23.9. So the first thing that we're going to calculate when looking for intrinsic value is we're going to calculate the earnings per share. And for this video, we're going to look 5 years out. You can do 10 years out if you want, because I only have so much whiteboard space and because I usually only look 5 years out. Sometimes I might look 10 if I'm really curious of what the numbers come out to, but 10 it might get a little fuzzy, but it's good to look at. But for this video, we're only going to do 5 years out. So what we're going to do is we have our first year, right? The earnings per share is $3.28. And we want to look at the growth rate. The growth rate is supposed to be 12.64%. That's what Apple's supposed to grow, right? Annually for the next 5 years. So we're going to multiply $3.28 by 12.64%, giving us $3.69. So that's year 2. That's what it's going to be projected to trade at next year. Then we're going to do the same exact thing. We're going to take $3.69 and we're going to multiply it by 12.64%. That comes out to $4.15, okay, for year 3. Then we're going to do the same exact thing. That's going to give us $4.67. And for the final year, we're going to have $5.26 for our 5-year out EPS. So now that we have our earnings per share 5 years out, we want to find out what a fair price for Apple would be in 5 years. So according to my calculations, a fair price for Apple would be $125.71. Now, how did I get that? Well, I took the earnings per share and I multiplied it by the PE ratio, our average PE ratio of what Apple usually trades at. So that was 23.9. So I multiplied $5.26 by 23.9, giving me 125.71, okay? So now we have our share price for what Apple would be at a fair value 5 years out, right? So now we want to find out what a fair price for Apple would be today, right? Because we're not 5 years out, we're not in 2025 not yet, although I'm sure a lot of people wish we were based on how 2020 has gone for a lot of people, but we are not there yet. So how do we calculate and get all the way down to this year? So what we're going to do is we're actually going to decrease by 15% because that's what we want our rate of return to be. So after doing out the math, I came up with a fair value of Apple today at $71.86. So how did I get to that? Well, like I just said, a fair value of Apple 5 years from now is $125.71, okay? So how do we get from 5 years to 1 year? Well, first we got to go to year 4, all right? So to get to year 4, you're going to take the share price of Apple at 5 years out, the fair value price 5 years out, $125.71. You're going to divide it by 1 plus 15%, giving you $109.31, okay? So that's the fair value of Apple 4 years from now in 2024. So now we got to get to 2023. So what you do is the same exact thing. You'll do $109.31 divided by 1 plus 15%, giving you a fair value of Apple in 2023 of $95.05. Then you do the same exact thing for year 2, giving you $82.65. Then you do the same exact thing one last time and you get to $71.86, guys. And that gives us the fair value of Apple today. Now, are we done? Yes. Just kidding. No, we're not done. So we forgot to apply one thing, and what's that? The margin of safety, because we don't want to buy companies at their fair value. No, we want to buy them below value. We're value investors. We want to get the deal. We want that Black Friday deal. We want the Kohl's sale. We want the 30% off coupon. Gimme, gimme, gimme. All right. Anyway, back to being serious here. So we came up with a 50% margin of safety, right, guys? So what does that mean? That means we want to buy Apple for 50% of what it's worth. So if you divide $71.86 by 2, you're gonna get Apple at 50% of its value at $35.93. Now, is that really feasible to get Apple that low? Probably not, to be perfectly honest with you guys. I don't know off the top of my head where Apple fell back in March and April, but I don't think it was this low. Actually, I don't think it's traded that low since about 2017 area, and I don't know if it'll ever go that low again, to be perfectly honest with you, because it's Apple. That's the bottom line, guys. Apple's an anomaly. Apple is just fantastic. It's Apple. Like, it's just Apple. That's all I can say about it. So I don't know if you get that low, and Apple's probably not the best example to run these numbers with, but it's a company everyone understands, and that's why I did it. But if you guys do run these numbers with other companies, you're going to see great results and you're going to become a much better investor, especially a better value investor, guys. So really hope you guys enjoyed this video. I really hope you guys got some value out of it. If you did, make sure to drop a like on the video. I really appreciate that. Don't forget to subscribe to the channel as well. Let me know down in the comments how you calculate intrinsic value, if you do it this way, if you do it one of the other ways that you can do it. And thanks for watching, guys. Have a great week, and I'll see you guys in the next video.